Welcome. In today's update, we're going to explore some critical aspects of the current economic landscape and how they may affect and impact your overall wealth strategy. So let's delve into the latest inflation, market risks, and what that means for your investments and the financial planning that we're doing. And we're going to start with number 1, economic and stock market risks. I know there's a lot on your mind recently, especially when it comes to the stock market and all the different aspects of risk that is out there. Now, I want to reiterate some of the things I've been talking about, not only for the last couple of years, but more importantly, since July. Inflation. Now, the stock market is really starting to see changes that are happening out there with inflation, but last week, Jay Powell, the Federal Reserve Chairman, spoke about the growing concern that he is having surrounding inflation. Now, there are a couple points that he was talking about, as well as some data that came out. And that data is what I want to actually highlight first. Now, the University of Michigan does reports on a monthly basis, and this one that just came out last week showed that the 1-year inflation rate is starting to rise again. Now we're back up to 4.4%, which is higher than the estimates. And then also what they noted was the 5 to 10 year inflation expectations are also starting to rise. So we're at 3.2%, but that's increasing now versus decreasing what we have been seeing over the last about year. So this is actually really starting to indicate that inflation concerns are more than just short-term fluctuations. And that is the element that we have really been seeing since July. So that actually is going against what the thought process of this immaculate disinflation. Now, while many have been hoping for, like I said, a smooth reduction in inflation, that's what this has really been signifying here, of that immaculate disinflation. The reality is that it's proving to be more complex and challenging. And the data suggests that we're not seeing the cooling of inflation that many had hoped for. So that is an element that we're really starting to worry about, because that can change the Federal Reserve and have them not only keep the higher for longer, but also maybe even start to increase interest rates again. So, in this context here, what I really say is that it's kind of vital to approach the idea of inflation expectations with a healthy dose of caution. Because what happens is that if we have softer growth readings, which is actually one thing that the federal government wants with Jay Powell and how he is trying to reduce inflation. But if we start to have that reading and we have an increase of inflation, that could be more stagflationary. And that's a stagnant economy, like I was talking about, with that high inflation rates. And this is actually what we've been talking about for the last number of months, that lead 3 category. So again, slowing of growth, increasing of inflation. And there's a lot of companies that do not do well in this environment. So that's the expectation from here, that we are going to be in this environment. And I would not expect rate cuts anytime soon, because of the fact that the Federal Reserve wants to keep that higher for longer with the interest rates as they are, and the fact that they're still trying to fight all the different inflationary environments. Now, the funny aspect here is that they actually had the chance to do this back in March, to really start to work on the economy and to fight inflation even on a more broad scope. And unfortunately, they chose not to, with how they went and bailed out the banks at that point in time. So that's where we're starting to see that there's a lot of different things that are happening with inflation, and we can't signify the all clear yet with all the different aspects that are coming in. So that's been inflation, but now we're starting to see it in a lot of different aspects with the risk that inflation is starting to really pose on us. And the most recently, that came from Moody's and their decision to change our debt and the outlook of the United States ratings to negative. Now, what's happening here is that this is following a similar move by Fitch on August 1st, and it highlights the concerns that are out there about the high level of the US government debt. Now, Fitch pointed out that the US government debt is now estimated around 113% of our GDP, which is significantly higher than many other countries with the same debt structure and ratings that the United States has. So, this is really serving as a clear warning that we need to address the fiscal challenges sooner rather than later. And this underlines the need for a cautious approach, and really something that, as we're taking a look at your own investments and strategies, we want to maintain the look into inflation as well as the economic growth and the complexities that are there, but also the interconnectedness as well. It's no wonder that we're downgrading our debt when we're issuing more debt to pay for some of the aspects of the inflation that we're trying to solve. So, as your wealth advisor here, my goal is to navigate these challenges effectively and keep your financial goals and well-being at the forefront. And that leads us to number 2, portfolio changes. All right, I want to pivot just a little bit here because we have been talking a lot about the economy and all the changes that have been happening there. But I want to talk about your portfolio and understanding your portfolio in the environment of all these subtleties that are going on, especially with the Federal Reserve. So first off here, there really is a prevailing sentiment that the market and the Federal Reserve will intervene as necessary. So what this is now saying is, especially since March, where we had the banking concerns and the Federal Reserve actually did step in, there's an expectation that they will do that whenever needed. So whenever something gets a little bit hard with the stock market, the bond market, or anything else, that the Federal Reserve will step in. And what this is doing now is leading a certain complacency and really kind of a lack of care of any risk that is out there, whether it's inflation or war or just a slowing of growth. Now, part of my job here is to help navigate this sentiment and to ensure that your portfolio is positioned to weather any market conditions. So when we're taking a look at the Federal Reserve and their actions, when we're taking a look at all the different things that we're seeing out there, first thing I'm going to sit and say is that people are really starting to think that the bond yields are not going to continue to go up anymore and that they may have peaked. So that's why you're starting to see more people start to flow into long-term bonds. And what we're doing now, this is what you call a shift in sentiment. Now, I do agree with them that there is probably a peaking of the bond yields in themselves, but to the point that we're ready to start investing into long-term bonds, it may not be yet. But what you're starting to see here is that we want to be moving away from positions that could benefit from rising yields and ones that may just be there if bond yields just don't go down. So that's where we're at with this delicate balance of bonds. But I want to ensure that this is not just a short-term type of a noise, but this is actually something that is going to be more a long-term trend. Well, that leads me to another aspect here. I want to be talking about some of the other changes that we'll be doing. First of all, we really have been seeing some strength in technology, communications, and healthcare related stocks. And those have been areas that we've had a part of your portfolio over the last number of years, but we want to start increasing those just because those are actually ones that will benefit in this environment. And they actually provide some unique attributes that we're wanting. So there's a lot going on, but just know we're not quite ready to invest in long-term bonds. The short term we're going to keep. The long term may not, but then we'll keep adding in technology, keep adding in some healthcare, and we'll also keep adding in communication related stocks. Number 3, wealth management and advanced planning. I want to move into some advanced planning aspects here. And there's actually a strategy that we need to be talking about more and more because of the fact that there's going to be a significant change coming up with taxes. And that is the sunsetting of the tax cuts at the end of 2025. So this is actually going to present some challenges, but also some opportunities out there. Now, the potential expiry of these tax cuts is crucial for your consideration for all the different financial strategies. And what we want to do here is figure out how these tax changes might affect your overall tax liabilities, and then really plan accordingly. So, one effective approach, and this is something that we have been talking about for a couple years now, is to consider a Roth conversion. Now, with the current lower tax brackets, it actually makes it really attractive right now, because there's a window of opportunity in the next couple years, this year, next year, and 2025, to make these conversions more beneficial. Because when we convert a traditional IRA into a Roth IRA, the growth can now be tax-free, even the withdrawals. And this could really benefit you with something like increasing tax rates. So if we pay more in just right now with the conversion, that's actually going to save us money if rates rise in the future. So that's part of the advanced plan that we want to go through right now, and not looking just beyond the numbers. It really is aligning with your financial strategies and your life goals. So when we talk about this, the retirement planning that we can do with this, the estate planning that we can do with this, or even your charitable gifting, these are all aspects that we'll be looking at when it comes to what we're talking about here with the Roth conversions, because they all play a pivotal role in building your comprehensive wealth plan. So this is again where we help to navigate these complex areas and ensuring that every decision aligns with your overall objectives and values. That's the aspect here, that if we can help to reduce taxes, increase the ability over time for potential growth, and align with not only transitioning money to family members in the future, but also what we want to be doing with charity and wealth enhancement. That's the piece that we can really start to say, no matter what, we're going to have the ability to help make all of these changes match your long-term goals. That is a powerful piece that we can be talking about when it comes to tax diversification. And that leads us to part number 4, our second opinion service. I want to highlight something that is unique to Lions Wealth Management, and that is our second opinion service. Now, this is an excellent opportunity for you to really gain some insights and reassurance about your overall wealth plan. Now, here's how it works. When you are looking at your overall wealth plan, you may have some questions, and that's why we're going to be offering a comprehensive discovery meeting. And what this means is that this is going to be a review of everything that you're doing right now, from where you're at now to where you want to go in the future. And we're going to dive deep into all the different aspects of your financial situation and the unique goals that you have. Now, out of this, one of 3 outcomes is going to emerge. First off, maybe there are actually everything is going right with respect to your overall wealth plan and you're on a good track. And we're going to let you know that there really are no changes that are needed, just to stay the course. Well, the second aspect could be that maybe there are some small aspects, some small changes that can be done. And we'll let you know that as well, so that you can go back and have a plan in place that you can implement on your own. Well, the last element here is that maybe there are some significant gaps in your overall wealth plan. And that's where we can come in and help to put together really just kind of a plan in place and a tailored idea and strategy list of how to bridge those gaps. And that's what we're talking about here with respect to the second opinion service, is a way that you can be bettering your overall wealth plan. But no matter what, whether you are in a good place, whether there are some major gaps, you can actually step away knowing you're going to be in a better place once we've implemented those changes. So with that, take us up on this, and you can actually go to our website and contact us by putting in your name, your email, and then in the description piece, just write second opinion. And we'll be happy to get in touch with you and actually go through on a complimentary basis the overall second opinion service and giving you the ideas that can help improve your wealth plan. Take care.